we're going to learn about, essentially, we're going to sort of pick apart some of this, this capital structure ideas. We're going to pick them apart and actually show 3 different ways to arrive at the same answer. And there's a couple of useful things about this. One useful thing about using different methods to get the same answer is you sort of are able to lift the hood of the car up and actually see a little bit more of what's in the car, because you can try to solve something from one direction and then see that, oh, you can actually solve it from coming from a different direction as well. You learn a little bit more about the mechanisms and the relationships between the concepts that are at play. Another reason is that when you have multiple different methods of computing something, with each having different data requirements, each having different parameters that you need to know in order to compute those things, that gives you more flexibility in the real world. If you have certain kinds of data but not others, that can make it easier to calculate certain types of expressions rather than others. If there's multiple ways of getting the same thing, you can use the one that corresponds to the data that you have, and that gives you just more flexibility to be able to get an evaluation on something with working with the actual data that you have available to you. Okay, so that's another reason why it's useful to have potentially three different alternative methods for calculating stuff. Okay, so we've been talking about we talked about the WACC. WACC is what we've been using to discount stuff. It gives us some concept of returns, the required returns to stockholders, and the required returns to bondholders. So we have, just in this general structure, we have some share of the firm or the project that's financed with equity. There's some required return on that equity that has to do with the opportunity cost of equity. What could that money be used for in other cases, other alternative uses? There's the contracts with your bondholders that you sign before you borrow money from them, and they're going to require a certain return according to what the prevailing interest rates are. And then if these interest payments are taxable, then we have to make an adjustment to the right-hand side here for the cost of debt, and we multiply that by 1 minus the tax rate to get the actual after-tax cost of debt. So there's essentially this WACC composes, right? It consists of returns to equity holders, and it consists of returns to bondholders. So we have to disaggregate that. We have to keep those two groups separate when we're thinking about how to discount projects, how to think about required returns on projects. So that's what we're going to be doing in this part here, thinking about incorporating capital structure into capital budgeting. All right, so there's 3 different ways of doing this. We're going to have adjusted net present value, or adjusted NPV. That's going to be similar to the way that we calculated the present value of the interest tax shield in order to get the value of the levered firm under Modigliani and Miller Proposition 1 with taxes. The techniques we use for that are going to be similar to the techniques we saw with Modigliani and Miller Proposition 1 with taxes. Flow to equity is going to be a method where we consider what the cash flows of a particular investment project are after interest has been paid. So you deduct interest from the cash flows of the project. You just consider what the cash flows to equity are, and then you discount those according to the costs the cost of equity capital, which under Modigliani and Miller Proposition 2 with taxes, that's going to be some function of the unlevered cost of equity, some function of the debt to equity ratio, a function of the difference between the cost of equity and the cost of debt, and then a function of the tax rate. So we're gonna distinguish between levered cash flows and unlevered cash flows, and we'll talk about more about what that is in a second. But then we're gonna use the levered cost of equity as our relevant discount rate. So the main differences between these three methods are the discount rate, the discount rate that's applied, the treatment of cash flows, levered versus unlevered cash flows, and then how to treat the initial investment. How to treat the initial investment. How to account for the initial investment cost, taking into account the fact that some of the investment may have been financed by debt rather than equity. So these are the three main dimensions along which these methods are going to vary. They're going to vary in terms of the discount rate that's applied. They're going to vary in terms of how the cash flows are treated, whether you're thinking about levered cash flows or unlevered cash flows, and then they're going to differ with respect to how they treat the initial investment. Okay, so that's kind of just very general and abstract for right now, but let's look at an example to make this more concrete. Okay, so let's look at an example from 2002 where this company Entergy purchased a nuclear power plant, and they spent $180 million to acquire that asset, and so then that asset was then put on their balance sheet. They financed that with equity. It was an all equity purchase. But we're going to look at some alternative scenarios in which maybe some of this initial investment would have been used, some borrowed money would have been used to finance this initial investment. So we'll use these three methods here to consider what happens under different under different financing structures. We'll compute them using those three different ways, and we'll find that we get the same answer regardless of which method we use. There's going to be some underlying value to this project, so that's sort of what's captured in this part of the slide. There's some product and service that this plant is going to generate. It's going to generate energy, which can be sold to businesses and consumers. They're going to pay a price for that. That's going to bring revenue into the company. And then there's going to be operating costs associated with that. So these are the fundamental, you can think of these as being the fundamentals, the fundamental characteristics of the project. So we're good now. Let's get to the distinction between, we'll talk about the distinction between unlevered cash flows and levered cash flows. But first, before we do that, let's think about just what the value of this purchase is, what the value of this asset is to Entergy after having purchased this project. So the revenues, in this case, the revenues associated with this project are $200 million per year. There's going to be some costs of $50 million per year. So we have operating income of $150 million per year. There's some taxes assessed on that. So 20% of that $150 million has to be paid in taxes. And so the overall cash flow of the project after taxes is going to be $120 million. So that's what the take-home money per year of this asset is going to be for the firm that purchased this power plant. $120 million per year. Okay, so that's all equity. That's an all equity purchase. It was an unlevered purchase. There was no debt taken out to make that investment. It's all equity. So the appropriate discount rate then for an all equity firm, if we remember our cost of capital equation, if there's no debt, then this top, this B is equal to, that's equal to 0. This B is equal to 0. So that makes this whole right-hand side cancel out, and all that we're left with for the cost of equity is the unlevered cost of equity. So that's what we use as the discount rate for these $120 million cash flows. So discounting those cash flows by 20% by the relevant discount rate, that gives you a PV of $600 million. Right, so $600 million is the PV of all the future cash that's generated. The investment costs you $180 million, and so the NPV, the present value of the cash flows in the future that you get, minus the cost of the investment, in this case, comes out to 120 million, and this is without any debt. So that's the baseline that we're considering. That's without any debt. Baseline, we had NPV of 420 million. Now we're going to consider this first method of calculating the value of the project, with some of the project being financed with some debt. So this is essentially, we're getting to the question of how does the leverage affect the value of this deal, for this purchase. And it's going to be in exactly the same way as it affected the value of the overall firm that we saw from last week. So we saw under Modigliani and Miller Proposition 1 with taxes, the value of the levered firm was equal to the value of the unlevered firm plus the PV of the interest tax shield. So that same principle is going to apply in the case that we're financing this particular project with leverage. The one difference, though, is that we're not thinking about overall firm value. We don't necessarily even need to know what the overall firm value is, or what the overall firm's capital structure is. All we need to know are the characteristics of the individual project that we're interested in evaluating. So in this case, we have this concept of adjusted present value, which takes the net present value in the all equity financing case, the value of the project in the case that the firm just uses equity, and then we consider that if the firm were to finance some of that with debt, they would shield themselves from some tax payments, and thereby increase the overall value of the project. And so the amount of that increase is going to be, just as before with the firm value, it's going to be the present value of the tax shield. In the same way, the extra additional value on this project is going to come from the present value of tax savings, which in this case, just as with the previous case, it's the tax rate times the amount of debt. That's the expression that captures the interest payments that accrue over time, and then discounts all of those, discounts the cumulative sum of those interest payments, the discounted sum of those interest payments back to the future, and that comes to just this expression of tax rate times leverage. We showed under Modigliani and Miller Proposition 1 without taxes that the value of the firm overall cannot change after leverage is taken on. So the capital structure without taxes has no possible way to affect the value of the firm. With taxes, there's an opportunity for leverage to save the firm in tax payments. It takes on debt. The interest payments are deducted from its pre-tax income. And so that pre-tax income is lowered, its overall tax bill is lowered. And so the choice of financing some of itself with debt produces some tax savings, which then has some present value equal to this tax rate times the leverage amount. So that comes out of the material that we had covered last week. So if you want more details on that, I covered that pretty extensively in Wednesday and Friday of last class, or last week's class. Okay, so just taking that, we know we're going to try to build on that concept. We're going to use the work that we did to show that was true in the last week, and we're going to build on that in this case of financing a project rather than just financing an overall firm. So this comes from the idea that any leverage you take on, just as the overall firm value doesn't change with leverage in the absence of taxes, neither does the overall project value change in the absence of taxes. But if there are taxes, that is going to save the firm some tax payments and thereby boost the value of the project by the amount of the present value of the tax savings. That's the essential idea with this adjusted present value method. So that's the bottom equation here of the adjusted present value being the net present value of the unlevered firm plus the present value of the tax savings, which is tax rate times leverage amount. Okay, so in our case, the NPV of the unlevered firm, that was the 420 million that we had calculated from the all equity deal. So that's part of this equation. We have NPV of the unlevered firm as one of our inputs. We have the present value of the tax shield as the other one of our inputs. That's the tax rate times the amount of leverage. We're going to assume here, let's just assume that the amount of borrowing was 31. Let's say the amount of borrowing was 38 million or 31.58 million. So our expression then for the adjusted present value is going to be what we had before for the net present value of the unlevered firm plus the 20% tax rate times the amount of borrowing, right? So that's going to be 0.2 times 31.58. That's going to be 6.32 million. So that's going to get added to the previous net present value, which was what we found in the unlevered case. So that's the adjusted net present value. That's just simply the same process we saw before of calculating the firm value under leverage when there are taxes to be paid. That's the adjusted present value method. There's a couple metrics that we can derive from this. So one of them is, and they'll be useful in different contexts, but one of them is the debt to value ratio. So in this case, the overall value of the firm. We can think about this actually in terms of like a balance sheet. So you think about assets and then liabilities and equity. We have a $180 million investment cost. So we buy that asset, and then that asset is on our books. And so that's land and capital and equipment that's on our balance sheet that is logged in the asset side of the balance sheet. But then we have this excess, and that's what we paid for that equipment and capital and land. But then there's excess value generated above and beyond what we paid for it. That's the net present value that we had calculated. So, we had a net present value of, or we had an adjusted present value of 426.32 million. So these are all in millions. So that's the overall asset side of the balance sheet. On the liabilities and equity, the overall value, this, if you add these together, this is going to be 606.32. That's the overall size of the asset side of the balance sheet. Now we have, how much debt do we have? We have 31.58 million. So debt is 31.58. And then if we just use the simple balance sheet identity, that we know that assets have to equal liabilities and equity, then we know that equity in this case is 574.74. So the overall firm value, the value of the assets of the firm is this 606.32. That's going to be what's in the denominator of this debt to value expression. So debt to value is going to have 31.58 in the numerator, and then 606.32 in the denominator. That's the S over S plus B that we've seen before from the WACC equation. That's going to be equal in this case to 5.21%. That's going to be useful when we do the third method of project valuation of using the weighted average cost of capital. That will be handy to know that number. There's also, the debt to equity ratio, which is simply, this would just be the 31.58 number divided by the equity portion of the firm, which, if we remember from this balance sheet model, this equity portion is the 574, which is, the 606.32 minus 31.58. That gives you 574.74. So that's the value of S, which can then be used to calculate the debt to equity ratio. So that's essentially what this is. That's what the denominator is here, 574.74. And that's arrived at. Alternatively, you can think of that as being 426.32 plus 180 minus 31.58. So that's going to be, that denominator is a little bit smaller, so that debt to equity ratio is 5.49%. That's a little bit greater than the debt to value ratio. That's just because the denominator is larger, right? So that's, those are metrics that we'll come back to later on. Let's consider the next method for computing the value of a particular project under a different capital structure, something that's not all equity financed. So the second way is to use this flow to equity, concept. The key thing here is that before we used unlevered cash flows, now we're going to use levered cash flows. And then we're going to discount by the levered discount rate. And that's RS. That's the cost of equity capital that we've seen before. Okay, so what's the difference between unlevered cash flows and levered cash flows? Let's look at the example. Remember, unlevered cash flows were 120 million from before. We can go back and remind ourselves what those were. Unlevered cash flows were just the revenues minus the costs, minus the taxes, and that gave us the 120 million of net income for the firm's the firm's project. Now, in this case, we're going to calculate levered cash flows, which is the residual cash flows to equity. You can think of this, you know, technically speaking, the levered cash flows are the residual cash flows to equity holders. So you're going to subtract off the flows of cash that go to bondholders. You're going to subtract those off first before you calculate what the equity holders earn in return for their investment. So the revenues and the costs are the same. We're going to assume a 10% cost of debt or a 10% interest rate. So we can take 200 of revenue minus 50 in cost. We subtract interest payments, which are 10% of 31.85 million. So that's 3.185 million. So that gets subtracted off. Next, you can get the after interest income, which is going to just subtract the interest from the difference between revenues and costs. And then that after interest income is going to be what the taxes are assessed on. So you take 20% taxes off of that 146.815 million, and you're left with levered cash flows of 117.45. So that's what we mean by levered cash flows. It's the cash flows netting out what portion of those cash flows are going to bondholders. So 117.45 was our number. That's the operative number that we'll be working with from now on for this second method. Again, we're going to assume that this persists in perpetuity. In general, what this means is that you never actually fully pay the debt back. You borrow that 31.85 million. You borrow that, but you keep renewing that, and you keep paying the 10% interest payments as long as the project is operating. And in this case, the project is operating in perpetuity. So you just maintain 31.85 million of debt on your books, or on your books associated with this project. You maintain that. You never actually pay that back. You compensate your lenders by just paying them 10% interest every period. So that one key piece of this method is that this debt, this 31.85 million, is actually never going to appear anywhere in the net present value calculation. You pay for the debt in terms of the interest payments that you make on those debt, which are captured entirely by the levered cash flows. So you account for that debt here rather than in the total amount of borrowing that occurs. That's one difference between this flow to equity method and the adjusted present value method from before. So now these are levered cash flows. Those already account for interest. Those are what the equity holders take home every year after they pay their bondholders. Now we have to discount this according to the levered cost of capital. Discount that according to the levered cost of capital. We use Modigliani and Miller proposition 2 with taxes to compute that. So these are parameters, all these parameters that we need for this equation are things that we've seen before. We know that the unlevered cost of equity is 20%. That was our initial assumption that we made all the way back here. That's what the unlevered cost of equity is. That's what a firm in that industry with that risk structure typically has to earn for its investors in order to to do just as well as the market as a whole. So that 20% is the unlevered cost of equity. We take the difference between the unlevered cost of equity and the cost of debt. The cost of debt is 10%. Next, we need the debt to equity ratio, and we calculated that, or we brought that up and we calculated that a little bit here, where we were considering the $31.58 million worth of borrowing. We looked at the equity that was implied by that amount of borrowing, which was this $574.74 million, which took into account the increased firm value or the increased project value that would accrue because of the tax shield benefit of having that debt. So that 574 million is the residual equity, and the debt to equity ratio that's implied by that amount of debt over the residual equity is 5.49%. So that's something that we're going to plug into this MM2 with taxes equation. That accounts for the debt to equity ratio. And then last of all, we just need the 1 minus the tax rate. The tax rate was 20%, and so this last term is just 0.8. And after we plug those in, we get that the levered cost of equity, right? The residual equity gets a little bit riskier, just as we saw with previous cases. In that blackjack example, or in the example of the levered firm whose underlying activities were the same, but the repurchase of stock and the requirement to pay interest actually increased the spread of the returns to equity holders under leverage. So I'd encourage you, if you don't remember how that worked, go back to maybe Monday or Wednesday's lecture from last week and remind yourself of how a firm taking on debt actually increases the spread of the residual returns to equity. The increase of that spread requires that the cost of equity be higher in order for it to be adjusted for risk. So in our capital asset pricing module, we saw that it was always necessary for riskier things to require higher returns. In this case, our pre-leverage cost of equity capital was 20%. Now our post-leverage cost of equity capital has increased to 20.44%. So that residual equity is going to have to earn a higher return in order to compensate for the fact that it's more risky than the equity in the absence of debt. Now that 20.44% is what then is going to be used as the discount rate for this 117.45. So now we have 117.45 million as our levered cash flows. Those occur in perpetuity, and we discount them by RS. So it's the levered. In general, it's the levered cash flows divided by the cost of levered equity, or the cost of capital under leverage. So in that case, we get 574.61 million as the present value of those levered cash flows. Now we have to discount these, or sorry, we've already discounted them, but we have to now subtract off the investment cost. Remember, the investment cost was 180 million. That's what the initial outlay was to purchase that asset. But if you remember our assumption that the debt was held in perpetuity, we never actually paid off that debt. I think I discussed that mainly on this slide. This 31.58 million of borrowing that we did, we don't pay for that we never actually pay back that principal in this case. We keep that on our books forever, and we only pay the interest payments that are associated with that debt. So that is not an extra cost that the firm is incurring. The cost of that debt is totally captured by the interest payments, which are captured by this 117.45. So we don't have to subtract that 31.58 million when we are computing the net present value of that project, because that 31.85 million is paid for with all interest rather than paying an amount up front. So that 130 the 31.58 million has already been accounted for in the interest payments. So we can subtract that 31.58 from the initial investment cost. That comes to 148.42 as the net investment cost. The investment cost net of the debt, or the all equity financed. You can think of this as the equity financed portion of the investment, right? So that's what gets subtracted off of the present value of levered cash flows. Those levered cash flows, again, already account for the cost of debt. So you only subtract off the portion of the investment cost that is equity financed. And so you subtract off 148.42, and you end up getting 426.2 million, which, if we remember from our method 1, except for maybe a little bit of a rounding error, that's exactly what we got under method 2, 426.32, 426.2, right? So those numbers are comparable to one another, right? So those are the first two of the methods. We'll go over the third one, the WAC method, starting next class.